The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. This year, we're witnessing a notable resurgence of meme stock mania, a phenomenon that first captured global attention back in 2021. Retail investors are once again driving significant volatility in certain stocks, including familiar names like AMC and GameStop, while newer players like Opendoor and Kohl's have entered the spotlight. This renewed frenzy is amplified by social media platforms like Reddit, where coordinated buying sprees are shaping market movements. So what's fueling this comeback of meme trading? How are retail and institutional investors responding? And what does this mean for market liquidity, risk appetite, and overall stability? Well, to find out more, joining me now is Zane Aw, who is the Senior Research Analyst at Phillip Securities Research. Zane, welcome to the show.
Hi, Hongbin. Thanks for having me on the show.
Thank you so much for joining us. Well, Zane, we're seeing a resurgence of meme stock mania this year, with retail investors driving huge volatility in stocks like AMC and GameStop, similar to what happened back in 2021. So given this backdrop, Zane, how would you describe the current state of the market and what's fueling this renewed frenzy?
Well, yeah, we are currently seeing a renewal of the meme mania we've seen in 2021. In terms of what's driving the resurgence, I believe it could be due to some sector rotation, where investors are currently moving some of the funds out from the market leaders like the Magnificent Seven. Have seen a strong recovery since April into some of the laggards like the meme sector. And another possible reason that's driving this rally could be the popularity of zero-day expiration options among the retail investors, because they can actually leverage using a small capital to actually get potentially huge returns with small price movements.
Okay, so is this renewed interest in meme stocks a sign of retail confidence or retail complacency?
I think it's a mix of both. On one hand, I think retail investors have grown to be more savvy 4 years on with a stronger understanding of the markets. There's been a shift from 2021. There was a lot of fear of missing out sentiment, and currently now, I think they're taking more a balanced approach with their portfolios consisting more of stocks with some fundamentals. And we have also seen them using a more AI-driven approach to actually detect sentiment and increase the odds of winning. However, on the other hand, I think there still remains an element of complacency. A portion of them still driven by the social media hype and push them to take on very risky positions. For example, in some of the recent case, there was a Chinese company called Phyton, which actually crashed over 90% in a single day after there was a huge hype on social media. That's one of the possible consequences.
Okay, so what does the return of meme trading then say about market liquidity and risk appetite in the market right now?
I think the resurgence of meme trading actually shows that the market liquidity actually remains abundant, fueled by these retail investors. They actually provide this significant liquidity, particularly in stocks that are heavily shorted or have heavy social media followings. This actually supports the market, even though institutional participation is more cautious. In terms of risk appetite, I think it highlights elevated risk taking by retail investors that are engaging in this speculative activity, taking huge profits from volatile price movements. And last but not least, we have actually seen that the use of riskier leverage instruments with a multiplier effect on daily returns and also options actually highlight this kind of high risk appetite adopted by retail investors right now.
So how are institutional investors reacting to all of this then?
In terms of institutional investors, I think it's a bit of a mix of caution as well as strategic adaptation. So actually most of the institutions remain skeptical and cautious about meme stocks due to the volatility and speculative nature. They feel that meme trading is very high risk and that could lead to some liquidity traps where retail investors can get caught. However, there are also some institutional players that are increasingly monitoring this meme stock dynamics closely, as retail fuel liquidity and as well as risk appetite is keeping the market vibrant. And they have actually used AI-powered sentiment analysis tools and real-time option flow data to actually understand retail behavior and potentially capitalize on these short-term price movements.
Right. So what are some of the risks retail investors should take note of? And is it not encouraged to, kind of go into this meme trading?
Yeah, in terms of the risk, I think it's the same as before. We have seen in 2021 there very volatile price movements. If you happen to be buying at the top, then you get risk. There's a risk of the price coming back down and you may not actually recover due to the fundamentals behind the company not being that strong. So that's actually the most important risk that retail investors should take note of.
Okay. Well, retail investors, they now make up over 20% of trading volume, and social media platforms like Reddit are still driving driving coordinated buying sprees here. How has the influence of retail traders evolved, do you think, Zane? And what impact does social media have on market dynamics today?
I think as compared to 4 years ago, I think social media still remains very central to driving the meme stock rally right now. They have actually became stronger. For example, if we look at the popular Reddit Wall Street Bets, that's actually behind the 2021 meme mania. Actually, number of members have, I think, more than tripled since 2021, and the spectacular growth trajectory actually highlights the rising prominence of this retail speculative trading, and they actually still actively post their trades and show their returns and try to harness the power of the masses. In terms of other platforms such as X, the influence is also notable. For example, you mentioned at the start Open Door. The rally for Open Door actually started when a hedge fund manager posted a bullish thesis on the stock, and that the stock had potential to be 100 bagger over the next few years. So that actually caught the attention of retail investors on X, and that created a huge buzz that fueled the surge in trading.
Well, new meme stocks like Open Door and Kohl's have gained momentum despite lacking strong fundamentals, often fueled by high short interest. How much have prices surged since the start of their meme stock phase?
I think we've seen a very strong surge. I think for Open Door it's about tripled or quadrupled since the start. Yeah, so that highlights a very strong price return that we are seeing since, I think, start of last month.
Okay. Then what makes these stocks attractive to meme traders, and how significant is the threat of short squeezes in today's environment?
I think what makes it attractive is the possibility of using a very low capital, because as retail investors, especially for very young investors, they're actually following these meme stocks. Their capital might be limited, so they're actually trying to turn a small capital into potentially huge returns. So that's a huge draw for them for meme stocks. Okay, I think in terms of the trend, it still remains quite similar as before, because with especially high short interest, people who are due to cover their short positions have to still cover them no matter what. And also, if they're lacking in terms of margin, the rapid price movement actually will increase the pressure of them to cover the shorts. So I think in terms of that, it still remains the same as well.
Okay. Well, with prices swinging wildly due to speculative trading and social media sentiment, what are the biggest risks for investors who want to jump into meme stocks as of right now? Could this mania pose broader risks to overall market stability? How long do you think this trend can last?
I think in terms of the meme mania we're currently seeing, it should be more contained as compared to before. I think because first up, institutional investors have actually learned from the experience past from 4 years before. They're better equipped to adjust risk management as well as some of the trading strategies in response to the meme-induced volatility. In terms of retail investors, as compared to before, currently I think they are facing some cost of living challenges. That's why they are more selective in terms of meme trading as compared to before, when there was an era of pandemic handouts, excess savings, and as well as staying at home. They actually created the perfect storm for this meme craze. So I feel it will be more contained this time with less frenzied meme stock rallies.
All right, some great information there. Thank you so much, Zane, for your time and your insights today.
Thanks, Hongbin.
Thank you. That was Zane Aw, Senior Research Analyst at Phillip Securities Research. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.